Welcome to Talk Tickers. So today we're going to dig into Hormel's fourth quarter earnings, a really interesting one for fiscal 2025. So at first glance, Hormel's latest quarter, it looked, well, pretty ugly. We're talking a big headline loss, a miss on revenue, and yet the stock rallied. So what on earth did investors see that the headlines missed? That's exactly what we're going to unpack right now.
Okay, so here's the plan. We'll kick things off with the quarter at a glance, then jump into management's playbook for 2026. After that, we'll read the tape on the market's reaction, and we'll wrap it all up with our rating the next call.
All right, let's dive right in. First up, the quarter at a glance.
Okay, so the first little glimmer of good news for investors was the adjusted earnings per share. It came in at 32 cents, and that was just a couple of cents ahead of what everyone was expecting. You know, it was that first sign that, hey, maybe this report isn't as bad as we feared. But the top line, yeah, that told a bit of a weaker story. Total revenue was about $3.2 billion, but that missed the mark by about $40 million. So you can see they did a good job managing the bottom line, but those sales were definitely a little soft.
And this is the number that made all the ugly headlines, a GAAP loss of 10 cents a share. Now, here's the key thing you got to understand. This was all driven by a massive non-cash write-down. We're talking $234 million. It's basically an accounting thing, not actual cash going out the door. And the market, well, it tends to look right past these one-off items.
So you can see why what really mattered wasn't that messy quarter, but how management framed it, and more importantly, what they promised for the year ahead. So let's get into their playbook for fiscal 2026. The interim CEO, Jeff Ettinger, he really set the tone perfectly. He came right out and said, look, fiscal 2025 was a challenging year, but he immediately pivoted to growth. This is classic stuff, you guys. It's what we call a kitchen sink quarter. They throw all the bad news at it once just to clear the decks for a fresh start. And right here, this is where the whole story turns. Just look at this guidance for fiscal 26. They're guiding for adjusted EPS between $1.43 and $1.51. Now, what's so critical about that? The midpoint of that range was actually higher than what Wall Street was expecting. And boom, right there, you've got a clear reason for investors to get optimistic. And to prove this wasn't just talk, they pointed to some real momentum in their core brands. I mean, look at Planters. Consumption up 12% now that distribution is back on track. The Span brand is still a global powerhouse. And Jennie-O was also called out as a key growth driver. And this slide, this really shows you how they plan to do it, how they plan to boost those margins. First, they're cutting about 250 corporate roles. Second, they're putting the whole portfolio under review, and they even called out Brazil as a drag, saying everything is under review. And third, they're pushing ahead with technology investments. See, it's not just a sales story. This is about operational leverage. Okay, so how did all of this actually translate into what the market did? Let's move on and read the tape. You know, context is absolutely everything here. I mean, coming into this report, Hormel stock was down a staggering 25% for the year. Meanwhile, the S&P 500 was up 16%, and the whole staples sector was basically flat. So to put it simply, the bar for any good news was, well, it was on the floor.
So you can imagine, for a stock that's been beaten down this badly, that forward-looking guidance meant everything. Investors were more than willing to just look right past the old news, the write-downs, because management gave them a credible path forward.
And the result? A classic relief rally. The stock popped, closing up nearly 4%, and look at the volume, almost double the average. Now, what does that tell you? It screams short sellers were running to cover their bets, and new buyers were jumping in, thinking, okay, the worst is finally over. So let's put it all together. What's our call on the stock from here? That brings us to our final section, the next call. After a big reset quarter like this, the million-dollar question is always, what do you do now? Is it a buy, sell, or hold? So let's lay out our thesis for the next year. Okay, here's the Talk Tickers thesis. Management was very clear. Q1 is going to be weak. Those strategic changes, they're going to take some time to kick in. So we expect the stock to probably trade sideways until that Q1 report comes out and proves that the bottom is truly in. After that, we see it gradually grinding higher as those margin improvements start to trickle through. You know, this is a classic show-me story. The company has to prove they can execute. And for that reason, we're giving it a market perform rating. And of course, a quick reminder, this is not financial advice.